Hello and welcome. On this video, we are gonna talk about intrinsic value calculation. So how do we calculate the intrinsic value of a company? The important thing here to know is, as Warren Buffett says, the price is what you pay for, the value is what you get. So we need to make sure that we are paying less than the value. So that's why we do this calculation of the intrinsic value. Let's start by example and then we can dig deeper. So let's say, for simplicity, you have a machine that creates you $1,000 per year. For a company, it's not that easy because for a company, you don't know how much money it will create you each year. So for simplicity, we will start with this example. But $1,000 that it will create you each year, it's not worth $1,000 today. So how much is it worth? You need to discount it to today and find out how much money you need to pay for $1,000 next year. And how do you do that? So you divide the amount of money that you will get in a year by the return that you want to get in that year. So the return that I want to get is 15%. That's a good return, and the calculation on it would be easier if I want to do it in my head. So I will divide it by 15%. And $1,000 in a year is right now worth $870. So if you tell me you are willing to give me $1,000 in a year, I would pay you $870 right now and get $1,000 from you next year. But what happens to the second year? So second year, then this calculation shouldn't work because it's 2 years from now. So let's change our calculation a little bit and add power. So the number, our base calculation is going to be the same thing, but we want the number to be the power of the number of years that has already passed. So let's select this. The first year is the same. So let's say next year it will create me another $1,000. Let's see how much is that worth. So $1,000 in 2 years is worth $756. So this machine is going to create me $1,000 forever. So let's try to expand this calculation for the next 20 years. And we can see as the years goes on, that $1,000 that this machine is creating for me is worth less and less and less. So let's continue this for a couple of more years. Let's say 60 years. And then in 60 years, this $1,000 is going to be worthless to me. I'm not going to pay anything for you giving me $1,000 in 60 years. But all of these amounts that I will get, all these $1,000 that I will get in the next 60 years, is worth to me today $6,665. So this is the intrinsic value of this machine that will create me $1,000 per year in perpetuity. So I will pay this amount or less. Then I will make 15% on my investment. So this is the easy way to do this calculation. For real world companies, it's not this easy because you don't know how much money they will make next year, but you get the idea. Let's change it up a little bit. And let's say next year, this machine will create me 10% more. So this year it's going to be creating me $1,000, but next year it's going to be 1,100. And let's expand that and see what happens. So now, as you can see, the intrinsic value has changed. So now, by knowing that this machine can create me each year 10% more than the last year, now this machine is worth to me 18,611. the growth rate of the company. Let's say you want to buy a company and you know that it's going to be creating more and more money each year. The growth rate for this machine right now is 10%, and the return that you want to get out of it. Right now, our calculation says 15%. Then with those things, you can do an intrinsic value calculation. So we call this discounted cash flow calculation. Warren Buffett says this is the best calculation you can do to find the intrinsic value, but his friend Charlie Munger says he has never seen him do it. So why is that? The response that Warren Buffett had is this is the best way to do the calculation, but if you need pen and paper to do the calculation, it means that it's too close. So if the intrinsic value is hitting you in the face, that this company is very undervalued, you buy it. If it's too close, if you need pen and paper to do the calculation, don't buy it. So he doesn't need to do the calculation. He can do it easily in his head and find out that the price is way lower than the intrinsic value. There are some dangers in using this calculation. Let's say instead of saying that this machine is going to grow at 10%, let's assume it's going to grow at 20%, and let's find out what happens. As you can see, each year, because the growth is higher than our discount rate, each year the value is going to be higher than the starting point. So then what happens? The intrinsic value turns into infinity. But this can't happen because let's say this number is in million. So this company is creating $10 million right now. And if we have something like 50% increase on the return of the company, after a couple of years, it's going to be a billion, then a trillion, then after 60 years, it's going to be higher than the GDP of the world. So this can't happen. Maybe a company can grow for 5 years at 50%, but after that, it's going to go down to 30%. And then for 5 years, it will grow at 30%. And then next year, it's going to be 20%. Then a couple of years, it will grow at 20%. Then it will go down to 15%. A couple of years at 15%. Then it's going to be 10%. And let's say it will grow at 10%. Then this company that creates us 10 million, then it's worth 1,748,000,000. So this is the basic idea behind calculating the intrinsic value. But as I said, if you need to do the calculation, it means that the price and intrinsic value is very close together. Just forget about that investment, move on to the next one. Find an investment that hits you in the face, that this is undervalued. That's when we buy those businesses, when the intrinsic value is way higher than the price. And with that, we are done with this video. Thank you for listening in. If you enjoyed, please share it with your friends. Tap the like button for the YouTube algorithm. Subscribe to the channel. And if you want me to talk about other things, please write a comment. Thank you so much. Enjoy the rest of your day and see you on the next one.